A very good morning, everyone. Welcome to today's webinar on valuation standards. I am Sia Aksagulati and honored to be your host for this informative session. Valuation standards always play a critical role in providing a framework for assessing the worth of assets, businesses, and financial instruments. These standards ensure consistency, transparency, and reliability in the valuation process, which is crucial for making informed decisions, facilitating investments, and maintaining trust in financial markets. Today, we are honored to have our chairman of Valuation Standard Board, Mr. Hansraj sir. Uh, I invite Mr. Hansraj sir for delivering the welcome address. Welcome, sir.
Thank you, Astha. It's really been a great honor for me to this as far as the Valuation Manthan Series 8. And today, naturally, we have a speaker, Chandar Sani ji. This is because of certain reason our scheduled speaker could not join, and I immediately requested Chandar ji, and he immediately agreed upon. I really appreciate Chandarji for your kind in this kind of emergent situation you are with this valuation standard board. I'm very grateful and thankful to you. Astha, you also taking care of whenever we need you in the system. And Rahul and Dimple, they are also very supportive as a team at the valuation standard board. Today's program, naturally, it's its eighth in the series and many more to go throughout the year. The objective, you all know, diverse knowledge gaining momentum to get best in our control as far as the subject is concerned, challenges in the subject concerned, valuation standard. And today, naturally, valuation multiples you see like so many things are there where our member needs and doubts to be cleared, or so many good things to be happen with, or the advancement how we are moving towards the development of this profession of the valuation. I welcome you all the each and every participants, my speaker for this day, the host Astha also, and the team at the Valuation Standard Board for taking a lead and bringing out so many good things and bringing laurel to this Valuation Standard Board also. Many newer things are in the system of which we are going to develop with over a period of time, whether the extension of the not limiting to the financial or the this only we will be in the going forward will be taking care of other verticals of the valuations also. So and many new things will which we will be keeping updated with the membership, and hopefully today's program will go a long way in better understanding and strengthening more in the as far as the knowledge is concerned. With these initial remarks, I welcome each one of you, and hopefully at the end of the session will be more equipped, more knowledgeable with the support from our speaker Chandra Sani ji. Now back to the Asta, over to you.
Yeah, thank you, sir, for your kind words. Now, ladies and gentlemen, it is my privilege to introduce our esteemed faculty member, Mr. Chandar Sahni, for today's webinar on valuation standards. Mr. Chandar is the founding partner and head of valuation and deals at Transit Corporate Advisor, bringing him with a wealth of expertise in valuation, transaction advisory, corporate finance, and deals, as well as tax, legal, and regulatory services. With over 18 years of experience in the field, Mr. Chandar has established himself as a seasoned professional known for his comprehensive understanding of valuation practices. We are fortunate to have Mr. Chandar join us today, as his vast knowledge and practical insight will undoubtedly enrich our understanding of valuation standards and their practical implications in today's complex business environment. Please join me in extending a warm welcome to Mr. Chandar. Thank you, sir. Over to you, sir.
Yeah, thank you, Asta. I'm just confirm that my screen is visible.
Yes, sir, it is visible. Your voice is audible, but your screen is not visible now.
Just now, is it visible?
Yes, sir.
Yeah. So thank you, Valuation Standard Board, for inviting me. I remember taking another session on valuation, wherein I had taken on the regulatory aspects on valuation. And I'm a firm believer in, development of knowledge, sharing of knowledge. And hence, when I received the call today morning, 7:30, I could not say no to this session. So I'm filling a gap for one another speaker, but I'll try to give my best so that I take the session in the spirit of what it is meant to be in terms of valuation multiples. So I'll just start my session. The presentation, what I could briefly gather, is divided into three parts. It's the overview of business valuation, valuation multiples, and the question and answer. Asta, any questions that come to you, take note of that. Then we can, discuss that. That is it.
Yes. At the end, we will cover all the questions together.
Sure.
Okay.
So I am just playing a small video some people might have seen, but maybe it's a Sunday morning and it will set the tone of the session.
शेयर का मतलब है लोग तुम्हारे काम में पैसा लगाकर हिस्सेदार बन जाते हैं। अब उनका पैसा तुम्हारे पास है, जो मर्जी करो। मगर भैया गोलगप्पों के बिजनेस में कौन पैसा लगाई? मैं गोलगप्पों के बिजनेस की ऐसी रिपोर्ट प्रोजेक्ट करूंगा, लोग समझेंगे ये बहुत बड़ा फूड इंडस्ट्री यूनिट है। और कंपनी का नाम रखेंगे पीपी वाटर बॉल्स। वो जो हमारे चाचा है ना लंदन में, लाल सिंह, वो जो साउथ लंदन में चाट पापड़ी बेचा है, हाँ, उसे 10-15 लाख मंगाई सकता है, क्योंकि उनका बहुत देर हो गया लंदन में। अरे यार, उसे पार्टनर क्यों नहीं बनाते? आपकी फॉरेन कोलैबोरेशन हो जाएगी। भैया लाल सिंह से कोलैबोरेशन? अरे लाल सिंह नहीं, रेड लाइन ऑफ लंदन से कोलैबोरेशन, 80% एक्सपोर्ट यूनिट। आपके शेयर तो हाथों हाथ बिक जाएंगे। एक फॉर्म पीपी वाटर बॉल्स कर देना भैया। यार मुझे तो बताओ कि किस शेयर में पैसा लगाऊं? भैया मैं तो उसी शेयर में पैसा लगाता हूँ जिसमें प्रसाद बताता है। प्रसाद से पूछ। क्यों भाई? देखो जी, पीपी वाटर बॉल्स 80% एक्सपोर्ट यूनिट है, फॉरेन कोलैबोरेशन है, राइट प्रॉस्पेक्ट्स है। ये वाटर बॉल्स क्या चीज है यार? यार कुछ भी हो तो अप्लाई कर दे, प्रसाद का अंदाजा कभी नहीं होता।
So see, with our stock markets at all-time high, I think it is important. See what happens when we do these kind of valuations. I mean, valuation is entirely based on the data inputs which is provided to a valuer. A lot of times it is observed that the data input is incomplete, and so the valuation also becomes incomplete. I emphasized last time also, and if you look into the recent IBBI orders which are being passed, there's a expectation which the regulator is having from a professional valuer, expectation that the valuer will do a due diligence, it will take due care, it will consider all the available data. The valuer will also independently try for the data available in public domain, and then the valuer will truly and fairly disclose whatever is come to the knowledge of the valuer. So what happens that, it is very important that this Valuation Manthan series is building the, knowledge spectrum of the valuers. And today the focus is on the valuation multiples, which if you look into, it looks very simple that, valuation multiple is too simple, probably the simplest. It can be done in a minute. But let me tell you, over my 18 year of career in valuation profession, valuation multiples are most challenging. And the reason being that, it's always easy to pick a number, but it could be very difficult to justify it if the process is not followed. So when we are saying of valuation, the focus is not on the number, the focus is always on the process. And once the process which is followed is right, fair, and true and complete, then I think any valuation can be defended. So like I mentioned, the presentation, the initial part is overview. So let me just take you through the overview, and then we will move on to the valuation multiple. So we have good time for the session, and just whenever any question is coming to your mind, whether for valuation multiple or for any other aspect of business valuation, you can just send as a query and I'll try to answer that. So first of all, we should understand that why do we actually need a valuation? Because valuation multiple is one approach. In fact, not even one approach, one methodology of a market approach. But how do you do that? For doing that, before you actually jump onto that, the fundamentals should be clear. So we have to understand that valuation is broadly required for three purposes, either for a transactional purpose or for a regulatory purpose or for a financial reporting purpose. Now, when I mean transactional purpose, there is an actual transaction. There is not a requirement of valuation per se, but when you buy something, when you sell something, you need to arrive at a price for that. You need to arrive at a value for that, right? So if you are doing a merger or demerger, you have to determine the purchase consideration and hence the valuation is required. We are not considering the regulatory aspects here. From a commercial standpoint, a valuation is required. When you are doing an initial public offer, again, a valuation is required. Because if you look into the IPO, there is no regulation on undertaking a formal report of an IPO, but the merchant banker along with the company arrives at a price which is actually based on the demand and supply. And this demand and supply has a very big role. Demand and supply equilibrium, which is called, has a very big role in assessment of a valuation multiple. Because what should be a multiple? When we will take, it should be a median multiple, it should be an average multiple, it should be a top tier multiple, bottom tier multiple, so many questions. So that means that valuation would change with the passage of time, and valuation is always at a point of time, right? Then let's say investment and fundraising. Again, like IPO, there could be a private investment that could be taking place. One could be looking at a sale of business or assets. There could be a family dispute. There could be a corporate dispute, right? It happens very frequent. In all these scenarios, you require a valuation. In fact, even if a company is going for a equity research, right? If company presumes that, the current market price is relatively less than the fundamental price, you typically go for a equity research. Equity research analysts prepare a financial model, assess the intrinsic value of a company based on the future cash flow. Let's say that value comes at 100 and the prevailing market price is 70. That means that there is that 30 rupees of gap for which a buy call can be given. So for doing an equity research or even for ascertainment of a credit rating, sometimes if you go for a credit rating upgrade, then at that time also a valuation may be required to assess that whether the financials are improving, financials are, whether your debt is reducing, whether your cash is increasing. So wherever there is a transaction, there is a valuation requirement. The second part is the regulatory valuation, wherein, I have already decided on a price and I want to do my transaction. Can I do a transaction at any price? If I am a company, if I am a shareholder, I want to sell certain shares, I want to buy certain shares, I want to issue certain shares to residents, to non-residents, to investors, to the promoter itself. Can we do at any price? The answer is no, because India has very strong valuation requirements for each of the different aspects, whether it's a transfer of shares, issue of shares, scheme of arrangement, whether it's a, it's an ESOP requirement or it's a buyback requirement. Wherever there is any of the transactions, it's not that a company can select any valuation and undertake the same. The commercial requirement must match with the regulatory requirement. And that is why the role of a professional comes. The regulated profession, a profession is regulated only when it is recognized under law. So which is the law under which a valuation profession is acknowledged or accepted? The latest and the law which is prevalent now is the IBBI regulations and registered valuer regulations, which is governed by the Companies Act. So there are registered valuer rules which actually enshrine that who has to do a valuation. As of now, the registered valuer rules cater to the insolvency cases and the Companies Act cases. SEBI has accepted the IBC valuation guidelines in a few cases, like in REIT and in WEIT. And we are seeing changes taking place in favor of IBBI registered valuers. There are other valuers like we as chartered accountants are doing valuation since long. There are merchant bankers who are doing valuation since long. But the idea that I want to give you is that if you are doing a transaction, do look at whether there is a requirement of valuation under any of the law of the land. It could be RBI, tax, SEBI, Companies Act, IBC. And let me tell you one thing very clearly. If there is a law of the land which is prescribed, law will always supersede the commercial requirement. And I'll give you an example. Go back and look to the Tata Docomo case. In Tata Docomo case, what exactly happened? That Tata Docomo had invested in Tata, right? And there was an understanding of exit at a particular point of time at a particular price. And when that exit event came, then what happened that the RBI had changed a regulation in FEMA, which said that the investor or a foreign investor cannot be assured a fixed rate of return. The valuation has to be done. In 2010, if you look, the valuation requirement was prescribed under RBI FDI regulations as per a discounted free cash flow method. So now if you do a discounted free cash flow method, somehow the valuation, which was a regulatory valuation, was not being able to meet the commercial requirement. So it was a case wherein, Mr. Cyrus Mistry was also there. And ultimately, the case went to arbitration and it got settled in arbitration. But a small change in valuation regulation, when you are doing the transaction, then what is the regulation? It is very, very important. Another aspect is financial reporting. Whenever the balance sheets are to be prepared, we need valuation for accounting purposes, like employee stock options plan. How should the compensation loss be booked in the books of accounts? Purchase price allocation. You have done an acquisition. How do we account for the acquisition? How do we account for the assets and liabilities which we have acquired? And if we have paid more than the book value of the assets and liabilities that are acquired, then where will the difference go? So the difference will go to some of the intangibles. It could be a trademark, it could be a brand, it could be a, any license or any other thing. But purchase price allocation is a financial reporting requirement wherein valuation is required. Again, a company has invested in another company. Does a valuation is required for impairment purposes? I mean, today the company, the subsidiary company, the investee company might be in losses. How do we do the valuation in that case? And similarly, there are other cases also. But one standard which is very important, which I would like to mention here is Ind AS 113, which is a fair value measurement. And that is the only Indian standard today. If we want to read about valuation, actually about fair value upon the practice, Ind AS 113 is the right standard. And I will take you through in the subsequent slides that actually Ind AS 113 advocates the use of market-based approaches. And the topic here that we are discussing today is multiples, and valuation multiples is a methodology which is a subset of a market-based approach. So we will discuss on that. It is very important that while we can say that valuation multiple is to be used, but what multiple has to be used? That depends upon a lot of aspects. And the most important aspect is what is the purpose, what is the standard, and what is the premise of valuation. So whether the purpose is transactional, financial reporting, or regulatory, we just discussed. So first we have to identify whether there is a regulation. If there is a regulation which says that you have to follow a net asset approach, if there is a regulation which says that you have to follow a discounted free cash flow methodology, you cannot follow a multiple approach. So multiple approach doesn't mean that it can be applied anywhere. Is there a regulation to that? That needs to be assessed first. Second, what is the standard and what is the premise of valuation? I'll cover it in the subsequent slides. What is the time horizon? Now let's say that I am a stock market investor and I want to buy certain shares. Whatever is the price which is prevailing in the market, that is the value for me. I can believe that it commands a different value, but if I have to buy today, that is the only price at which I can only decide whether to buy or not today. But if I have to buy, I have to buy using the market pricing only. However, if the market falls, if the market moves up, there are, heavy swings, you have to understand that if I am a long-term investor, then for me, the market methodology is not that relevant, because market will always fluctuate depending upon the demand and supply. We discussed that, right? But what is the fundamental valuation? That may not be able to be assessed by the 1-day market multiple. So for that, we need to take either a long-term average valuation multiple, which could be also be called as a stable valuation multiple, or we can refer the valuation through other approaches, including the asset approach. If it's an asset heavy industry, if it's a power plant, we can value a power plant based on an asset approach. If it is again a power plant, we can also value a power plant based on the income approach, right? There would be a power purchase agreement, and the concession, the period can be discounted, and a DCF valuation can be arrived. So time horizon is very important. And it's not that a valuation is good to be used for all purposes. A valuation is used for a stock option is good for a valuation as a financial reporting, and the same valuation can be given to the investor. So we have to understand that what is the valuation which is being used, and what are the type of shareholders. So for example, is it a minority valuation or is it a controlling valuation? Is it an enterprise valuation or is it an equity valuation? See, it looks so simple. I'm sure, those who are actually doing valuation on a day-to-day basis might be finding it easy. But let me tell you that these are the basic foundation is where the mistake happens. I have seen even professionals applying enterprise valuation multiples and arriving at an equity value. How is that possible? So I will again explain. Understand that it is important that in this Manthan series, we make our foundation strong. And most of the time, it's not that because of a complex valuation methodologies or because of complex models, the mistakes are there. Most of the mistakes happen because we do not follow the basic guidelines or basic standards that are supposed to be followed. So we mentioned on the standard of value, right? Standard of value could be a fair market value, it could be a fair value, or it could be an investment value. I'm not going into the technical aspects of it, but just to give you an understanding that fair value standard is taken from Ind AS 113, which says that what is the price that would be received to sell an asset or to transfer a liability in an orderly transaction between market participants. So Ind AS 113 is market participant driven. It requires a valuation, and the valuation is the price that would come upon the transfer of an liability or when we sell the asset, right? And when we say fair market value and fair value are actually, you can see that there is not much of difference, but fair market value has a willing buyer, willing seller concept. So there's a willing buyer, there's a willing seller, and it's an open market. We are doing a transaction, right? So fair value is used for regulatory purposes. Fair market value is used for commercial purposes, and investment valuation is used for specific purposes. Like I am a company A, I want to buy a company B. So as company A, what should be the value of company B to me? So if I do it on a market participant basis, it's a fair value, wherein I am not factoring in any synergies that could flow to a particular investor. But when we are looking at from an investment value, we are actually looking at that what are the potential synergies that can actually come to a particular investor based on that particular investor's requirement. If I am buying a plot which is adjacent to me, there is a synergy for me. But if you have to buy the same plot, there cannot be synergy because you are living at a different place, I am living at a different place. So these three standards are there which needs to be followed for all valuations. What is the premise of valuation? I mean, premise is broadly either an business can be valued or an asset can be valued on a going concern basis. Continuity of operations are presumed in that, or it is to be valued under liquidation. That means that business is not as a going concern. There are restrictions. For example, let us take an example of insolvency cases. In insolvency cases, we do the valuation of the assets on a fair value basis and on a liquidation value basis. Now, liquidation in itself can be of two types. Whether it could be orderly liquidation, or it could be forced liquidation. So orderly liquidation means that there will be adequate time to sell the assets. It's not that, you have to say dispose of everything in 2 days. If you start doing that forced liquidation, then the value reduces, because then, again, you have to understand that valuation is driven by the fundamental principles of demand and supply. And the moment anybody knows that one has to sell an asset and there are only 2 days, the value will significantly reduce. So it would be called as a forced liquidation. And what about orderly liquidation? That yes, there is a 6 to 9 months time. And let's say that you sell the assets and then liquidate it. So it is important that generally when we do valuation, business valuations, we always presume a going concern concept. We do not presume that the business will be liquidated. However, when there is a valuation specifically for a distress case, then there is a scenario wherein the valuation could be required on a liquidation base. And there also the first preference is to do liquidation on an orderly base. Because if you do liquidation on a forced base, then the valuation numbers could be very, very different. And that is not the object. The idea is to value maximize, because there are stakes involved of, other institutions and all. So now coming to the enterprise and equity value, see, equity value is the value for the equity shareholders. But if we look into the cap table, if we look into the capital structure, then besides the equity shareholders, there are preference shareholders and there could be some borrowings, right? When we consider the value from the point of view of equity, preference, and the borrowers, then that becomes the enterprise valuation. So enterprise valuation is value of equity plus valuation of debt, right? If we add, and for debt, actually we take net debt. Net debt means that debt minus cash and cash equivalents. And that is actually the enterprise value, which is also called as the value of the firm. So value of the firm equates to value of all the assets of the company, whether it's a fixed assets, it's a net current assets, it's an intangible assets. So if we do a DCF valuation, if we do a comparable companies market multiples, comparable companies transaction multiples, it gives us the value of the firm. And the multiples, if we use equity multiples, it will give us the value of equity also. So the message here is that when we are using a multiple, we should know that whether we are using an enterprise valuation multiple or an equity valuation multiple. And then if we are using an enterprise valuation multiple, then we have to do adjustments for debt and cash, and also maybe some surplus assets to arrive at an equity valuation. So this slide actually is again building the base of how the valuation multiples should be used, and which kind of multiples which we have to use, and the multiple will result in what kind of valuation, right? Broadly, if we see, then one message that I had given is that the valuation is driven by demand and supply equilibrium. Another message is that actually the valuation is driven by what are the operating assets and what is the cash flows. So, and this thing also I will try to connect with the multiples, that, cash flow is, suppose you say that you do a valuation based on a PE multiple, right? Now, what is PE? PE is profit earning multiple. So PE multiple, if you look into, then what is PE multiple? PAT, is PAT cash flow? Answer is no. PAT is profit after tax. That means that there is depreciation which is deducted there, and there are other expenses deducted, which could be on notional basis, which may be on non-cash basis. So ideally, when we do valuation, we give more focus on cash flow, the models which actually result in hard cash. So PE multiple, even though it's a fancy term and it's actually used in relative valuations in capital markets, but let me tell you that the investors will always look at the cash flow based valuations. And even today, the startup investors have also started looking into that. I mean, earlier, the startup investors, maybe a VC investors, pre-PE investors, they were more inclined in, raising the top line. And, they were not concerned about actually the cash metrics. But now you can see from the likes of Paytms and other companies, Zomato, I mean, these companies have actually started demonstrating that they are now EBITDA positive, and they are now, reaching towards EBITDA positive, and they will be EBITDA positive in some time. Why? Because if a business is not able to generate cash, then what is the value of that business? I mean, an investor can pump in any amount of money, but if there is no return, if the cost is more than the return, then how is the business viable? So the focus now is more on and this is the fundamental again. I mean, if I am having money, I want to give you, you can always take that. But whether a prudent investor would give his own money, whether a corporate, and that is why, we come across in our day-to-day routine many transactions. You open a newspaper, you will see that this company has got 10 million, this company has got 20 million. And when typically you go practically to a corporate and say that please acquire this company, and so investor has invested and given so much of valuation multiple, the corporate does not give that kind of multiple. Why? Because corporate is interested in what is the cash profit. Corporate is interested in what are the operating assets. Corporate is not interested in jacking up of the turnover and just building up a case hypothetically that profit will come in future. That is why look into the valuation multiples of M&A transactions and how different are they from a valuation multiple of private equity and venture capital transactions. And why? Because M&A multiples are the grounded multiples which actually companies are interested to give to the other companies for acquisition. But when it comes to the VC multiples, the PE multiples, we see that, because startups don't have much history. So that is why the multiples of investments are actually seen to be too higher and probably non-comparable. So please, if you are doing a valuation for your client, you can refer to the valuation multiples of M&A transactions if that is done by corporates. But in my personal view, comparing a valuation of a private company with a private equity valuation which has been given to another company may not be a prudent thinking, because you cannot expect a valuation multiple of 30 times of turnover or 50 times of turnover. It could be challenging for you to support. That could be an exception, but may not be there for all the companies. So we mentioned on Ind AS 113 that Ind AS 113 is a market-based measurement, and it gives focus to the observable input. So what Ind AS 113 says, that there are 3 levels of hierarchy: level 1, level 2, and level 3. And what it says is that a valuer should maximize the observable input. What is an observable input? Let's take an example. A company is listed on the stock exchange. That is the price. I mean, why do you need to dig deeper? If the price is frequent, the company's share are frequently traded, that is the price. That is what is there and known on the valuation date. If a company is not listed, then what do? Then you apply comparable companies approach. The methodology, the market-based approach, which we have to discuss today, is comparable companies market multiple approach, wherein we benchmark a private company valuation to the listed companies, to the peers in the industry. We take a mean or median of the multiples of the listed company, which are the peers, and then based on that, a valuation is arrived after appropriate adjustments. of discounts, premiums, and other aspects. So the idea is that the first preference is to market-based approach. If company is listed, second preference is to comparable transactions if the company is not listed, and only at a third level a discounted cash flow comes. And in discounted cash flow also, if there is one plant of a company, you can project on that basis. But management can tell you that it's coming up with four new plants. So what do you do in that case? I mean, do you do a projections of 5 plants? If you do a projection of 5 plants, maybe the value could be 3x. That may not be prudent. So you have to understand that as valuers, the concept is known or knowable as on valuation date. So whether all of these things were knowable on the valuation date, if yes, all these can be taken. But most of the time, it could be hypothetical that something is not known, but it is projected, it is estimated. I don't think that's the right strategy to do, because that may fail to meet the observable inputs requirements. Let's switch now to the valuation approaches. So irrespective of who does the valuation and wherever one does the valuation, whether sitting in here or any part of the globe, internationally valuation has only 3 approaches, which is income approach, asset approach, and market approach. When we dig deeper, then asset approach is whether you can take a book value of an asset, whether you can take a liquidation value of an asset, whether you can take a replacement value of an asset, right? That's not the scope of discussion in this session, but you should know that there is an asset approach. But practically on a going concern basis, like I said, we do not apply asset approach unless and until it's an asset heavy business, and there is a data limitation for other approaches. Second approach is income based approach. So the standards tell us that if a company, like if there is a focus on cash flow, if there is a focus on operating profitability, then what is the right approach? That's the discounted cash flow approach. Because how does a discounted cash flow work? For a discounted cash flow, the future projections of a company is made, and out of the future projections, whatever will be the net cash inflows to the company. Net cash inflows is the cash inflows after reducing the potential capex, the potential opex, and all costs which is there. The net cash inflows are estimated, and then they are discounted to the valuation date, and then basis that a discounted cash flow valuation is done. Mostly applied in all the cases. Regulator also prefers discounted cash flow approach. Again, the challenge is whether what all is known or knowable on the valuation date, and how to what extent that is observable. So remember that DCF is also called as a garbage in, garbage out. And most of the times I've seen that, valuers don't do their independent review and validation of the projections. And that is where the challenges are coming. Most of the orders of the regulators are coming because probably it takes a lot of time to sanitize the projections, to sanitize with the past trend of the company itself, to sanitize with the peers. Like if my profit margin, I am projecting my profit margin as 12%, let's say EBITDA margin is 12%, the peers are having margin of 17%. There has to be a reason why my profitability is less. If my debt is more, my turnover is less, my growth is less, I need to benchmark my future performance with my past performance. I need to benchmark my future performance with the industry performance, because a company is a subset of the industry, and an industry is a subset of the economy. So whether India is growing, if it's an Indian company, whether US is growing, if it's a US company, we need to look into the macro and also the micro aspects. And DCF requires a lot of time in review of the model. Because let me tell you, if the model is incomplete, if the model is not correctly made, if the model cannot be justified, DCF valuation is actually of no use, because then it would be a present value discounting of whatever is provided, and then one can land in danger. So there's an expectation of the regulator. In fact, even if you look into the valuation standards, then a valuer is required to take due care. A valuer is required to do, valuer is not supposed to prepare the projections, but valuer is required to dig deeper, ask for relevant questions, understand why these projections are made, how these projections are made, do its independent assessment by benchmarking with the past and the comparable companies, and only after being satisfied should a discounted cash flow valuation be applied. Otherwise, if a valuer says like this, that, my role is only to apply a discount rate, a growth rate, answer is maybe you could land in trouble. You should be, because it is a responsibility of the valuer to actually make sure that there is enough evidence for you to do the valuation. So don't think that if the data is a limitation, you can just put a caveat. Caveat will not save. There are now only permissible caveat in the registered valuer regulations. You cannot just put any caveats. Those, if you put any caveat and do the valuation basis a management representation, that is considered to be a violation of the registered valuer rules. So please make sure that whenever a valuation is being done, the model is sanitized, understood, thoroughly discussed with the management. Maybe the same is modified by the management, and then right kind of discounts and premiums are applied for arriving at a valuation. The third approach is the market-based approach, which again, now when we say market, what does it mean? For us, we are dealing in equity shares. So one market is the stock exchanges. And when we look into the stock exchanges result in what kind of valuation? Minority valuation or control valuation? So if you have to go and buy TCS, can you buy TCS as a company from the market? Can you buy 40% shares? No. Can you buy maybe 1 lakh shares? Maybe yes, depending upon the available float. So the market price which is there list on a recognized stock exchange, let's say BSE and NSE, that market price is the minority price. That is not a controlling price. So when we apply comparable companies market multiple, the valuation is actually a minority valuation. It's not a controlling valuation. And that is what actually I had mentioned initially also, that what is the valuation requirement? If I have to value employee stock option plan, I should look no further, apply a CCM method. But if I have to sell a company, should CCM valuation be the right approach? May not be. Because market may be valuing something, market may not be valuing something. So comparable companies market multiple approach is resulting in a minority-based valuation. And comparable transaction multiples, how is it different? So comparable transaction is if there is a private company, and in a private company, an investor has invested, then when an investor invests, investor takes some kind of controlling stake, or at least some kind of special rights. Those special rights or controlling stake actually give that valuation a controlling valuation. Understand? So comparable transaction multiples by default is a controlling transaction, and comparable market multiple is by default a minority valuation. The multiples and all could be a P multiple, EV/EBITDA multiple, book value multiple, sales multiple, GVMV multiple, any kind of multiple. We will take that up. But the same multiple, when it done is in private market, results in a controlling valuation. The same multiples, when they are taken in a public market, results in minority valuation. And then there are other methods as well, which we have to take. Asta, if there are any queries, maybe we can take a couple. Let me know if there are any.
Sir, not yet. We will discuss all the queries at the end of the session.
Okay. Yeah. So now there are, valuation across the business cycle follow the law of economics. What does this mean? that, there are different type of companies and there are different type of valuation methodologies. And depending upon the stage of the company, whether it's a startup company, growing company, high growth company, mature company, or a declining company, different valuation methodologies are to be used. And one thing which is important is that what is the availability of data and reliable data. Data could be available, but it may not be reliable. A company can give you projections, it may not be reliable. There could be only one comparable company listed. Now, whether if there is only one comparable company listed, should we just apply and say that that is the valuation multiples? May not be. So all these things have to be understood. The data has to be understood, and only basis that the valuation has to be derived. Like I just touched upon the registered valuer provisions, that it is the responsibility of the valuer to assess reasonableness of information, to find sufficient evidence to support the valuation, and for fixed assets and inventory to ensure that the site visits are made. There are now uniform valuation standards. There are formats of report, disclosure requirements, model code of conduct, and expectation from a professional to be competent, follow due care, and stay independent. So make sure that, all these things are taken care of as required under the IBBA regulations. Now, let's now jump to the second part, wherein the discussion will be done on how should we do a valuation, because in valuation, the process is more important than anything. So what should be the proper process that we should follow? And in the valuation, we will focus primarily on the comparable valuation multiples, because that is where the specific topic of the day is. So first, we should understand the purpose of valuation. We have discussed that. Based upon the purpose, whether it's a regulatory purpose, or it's a transactional purpose, or a financial reporting purpose, we should ask for the information from the company. After the information, and information is not only the valuation date information, there must be a review of the last audited balance sheet. Most of the cases I've seen that generally the clients would also see, clients also want a particular kind of valuation in a particular manner, right? That does not mean that we should not go back. We should not look at the historical audited balance sheet. We need to look at the historical balance sheet, the management discussion reports, the auditor reports. There could be certain qualifications. There could be certain statements. There could be internal audit reports. So it is important to ask for the historical information of the company, the tax returns of the company, the future financial of the company, the understanding about the peer company. We should take the perspective from the management. Who are the peers as per their view? I'm not saying you take those peers, but have an understanding, take the view of the management, do your independent assessment, and then proceed. Once there are the financials, it is not that we have to just take the financials and apply. We must do the financial analysis and normalization adjustments. There could be some exceptional items, some extraordinary items in the projections, in the historical numbers. Those should be eliminated. The idea is to arrive at the normalized cash flows, and think how sensitive a relative valuation model is. So it typically in a DCF model, what we do, that we perform, let's say, a 5-year projections, and then basis we do. So suppose in 1 year, there is an exceptional item, and in 4 years, there is no exceptional item. And if the valuer fails to remove the impact of that, the adjustment, there will be a small error, right? But what if we are applying a valuation multiple? Because valuation multiple is only applied on normalized financials. So if the financials are not normalized and that is extrapolated, correct? You understand? For example, if a company was having a profit of 100, and out of that 100, let's say that 40 was due to, exceptional gains on transfer of land. Now, exceptional gains on transfer of land has to appear in the P&L account, correct? So what happens that actually the normalized profit is only 60 and I have to give a suppose P multiple of 10. So 60 multiplied by 10 is 600 and 100 multiplied by 10 is 1000. So there is a difference of 400 that will come if the financials are not normalized. So very important to normalize, and for normalization, actually it's important to understand the industry. What is my industry? It's not that all the industries get the same profitability. There are different industries. In sectors, there are different industries. In fact, in industries, there are sub-industries. For example, you can say FMCG industry, but FMCG personal care and FMCG food commands a different multiples. So we have to go at a micro level and do assessment till a micro level, find all the companies in that spectrum, and then take a median of that, adjust for the outliers, and then only a valuation multiple can be given. It's not that, we can select any company, because I have seen that, see, for a regulatory valuation, I mean, it's not it is very important that a complete diligence and a process is followed rather than just a particular shortcut that can go wrong actually. Basis the industry trend, the forecasting of the company performance is to be done. The forecasting is to be done by the management, not by the valuer, but the review has to be done by the valuer. And then basis that, we need to apply the appropriate valuation methodologies. And then depending upon that, what is the kind of valuation requirement, whether it's a controlling valuation requirement or it's a minority valuation requirement, we have to perform value adjustments, we have to conclude, we have to document, and we have to report. That's a proper process that we have to follow for any valuation engagement. And if you look into this slide, then see there are different methodologies like we discussed. And some methodologies I mentioned are resulting in minority valuations, and some are resulting in control valuation. Some are resulting in equity valuation, and some are resulting in enterprise valuation. So it's very important that if you are applying a comparable companies multiple method, then in comparable companies multiple also, if we are applying a P multiple or a book value multiple, then it is actually when we say P is taken by the profit after tax, and profit after tax is meant for the equity shareholders of the company. If we say book value is actually the net worth, and net worth again is meant for the equity shareholders of the company. So if we apply a P multiple or a book value multiple, the resultant value will be the equity value. But what if we apply an EBIT multiple or an EBITDA multiple? EBIT and EBITDA are actually as good as operating cash flows. And that is why EBIT and EBITDA are mostly applied in comparable companies methodologies. But EBIT and EBITDA, you see that we have not yet reduced the interest. So when we have not reduced the interest and giving the multiple, because in PAT, the interest is already deducted. In EBITDA and EBIT, it is earning before interest and taxes, and earning before interest, tax, and depreciation and amortization. So these two multiples are actually leading to enterprise value, and the PE and book value are actually leading to the equity value. So it's important to understand. So I thought I should just share this. Let's just jump to relative valuations. And what exactly is relative valuation? See, we discussed that in relative valuation, we have to benchmark our company. So our company is, let's say, an unlisted company, and we have to compare our valuation with the listed peers. So what needs to be done? We need to first identify that what are the comparable assets. And in this case, basically, what are the comparable companies, I would say. Correct? So I'm just reading assets as companies. We have to convert them into standardized value. Standardized value is like in our case, because our valuation is a valuation of shares. So standardized valuation would be in financial metrics, like what is a P multiple, what is an EV/EBITDA multiple, what is a book value multiple, what is a sales valuation multiple. So we identified that what are the peer companies. We converted those peer companies' financials into metrics, into multiples, and then we compared it. And that leads to a relative valuation. See, understand that relative valuation, if you look into markets, stock markets, most valuation in stock markets are based on relative valuation. Nobody is doing a DCF. If I have to buy something today, there is no DCF. Only if I have to assess whether this price is less or more, then only there is a requirement of a DCF. So, I mean, a simple aspect could be that we can say that all the company's latest financial would be available, right? If you go today in the stock market, let's say we have to see that what's the valuation of Reliance. Then we know that, Reliance has already declared March 2023 results, because for stock markets, all the listed companies have to disclose their financials within 45 days of the end of the quarter. So when we say 45 days, so every 45 days, if we see after the end of the quarter, then the preceding quarter financials would be available. So when we do these relative valuations, generally we look into the trailing 12 months number, because trailing 12 months number demonstrate the latest financials of that company. So basically here, the perspective is that, relative valuation is mostly applied, but it is prone to error. And why is it prone to error? Because, we should understand that what are the multiples we are taking? How does this multiple works? Why a beta multiple is better than a PE multiple? What is the extent of depreciation and interest in the company? And then what should we do after we have taken all the comparable companies? There are so many comparables. Sometimes there are 100 comparables that comes. What do? Should you just pick what suits you, or should you follow a process? What should be a process? I mean, all these questions are important. We'll discuss on these, that, whether mean is appropriate, whether median is appropriate, whether the test of frequently traded is appropriate, right? So too many aspects are there, micro aspects in relative valuation, which we will all discuss. Whether actually the companies are comparable. I mean, how do you actually find companies? Is there a software? Whether you should look at Google, you should look at company website, you should look at some softwares, what should be the process? The message is that whatever way we do find the comparables, it should follow a particular process, and there should be, diligence and due care. So arriving at a value is not difficult, but following a process is what will differentiate your valuation from the valuation of another person. And then, how much you can defend it. Even if it comes to discounting, whether there is a statistical measurement or it's just 20%, 30%, what comes to the mind, or what maybe other people are using, there should be quantification of what you are doing. These questions have been raised in the recent past, and only if a valuer has been able to substantiate the reasoning and the thought process, then I think the valuer has not got punished. But in other cases, there have been serious consequences because of that. And if you look into that last line, then for comparable, the business model, the product profile, the geography, stage of the size of the business, the profitability margins, the level of debt equity, everything has a crucial role. But if we just summarize this like we do in transfer pricing, there is a FAR analysis, functions, assets, and risk. And that FAR analysis actually results in better comparability of the comparison. Now, recently I had given a presentation on IPO, and we were also working on a transaction. And if you look into this particular slide, it's a very fantastic slide. And the idea is that IPO, and why I'm giving you an example of IPO, because in IPO, there is no formal valuation requirement. And it is actually relative valuation. It is demand and supply based. It is actually based on the timing on which the valuation is happening. And same things apply on comparable companies valuation. No, when you do a multiple, then multiple is done at a point of time. Now, what is that point of time? Whether that point of time is the right point of time is the question for an IPO. To what extent is the market volatility? Let me give you an example again. On 31st March 2020, we had to do a valuation. The markets were down 40%. We all know, because of COVID. Should we just take the multiple which was there on 31st of March 2020 and benchmark? There is no guidance as such. But then at that time, people started thinking that what should be done in those kind of scenario. And then people went back to think of, the last scenario which came like 2000 boom, that bubble which burst and all. The idea is that it's not that we have to keep our mind open and then apply the valuation approach. So if market is highly volatile and the market is unstable, we cannot just take valuation of that point of time. We have to increase the period of multiple. So what we did practically was that instead of taking a 1-day multiple, we took a 3 months average multiple. Because probably a 3 months or 6 month average multiple would give a more stable approach to the valuation. What are the regulatory aspects surrounding that? How is my sector? It's not that a sector which was booming 10 years back may be booming today. Sectoral performances keeps on changing. So how is my sector performing? In that sector, how is my industry performing? In that industry, how is my specific industry performing? What is the competitiveness in the industry? How am I differentiated? What is the demand and supply equilibrium? What are the macroeconomics conditions? What are the more IPO pipelines? All of these things are important to be assessed for the short term, mid term, and long term. And the valuation will vary if the timing will vary. So the message is very clear that comparable company valuation is good for a point of time. But having said that, if we are assessing, see, when we have to do valuation as a professional, we are not doing valuation for speculative purposes. The understanding is that there has to be a stable valuation. Whether we do by CCM method, CTM method, DCF method, NAV method, the valuation has to be stable. So if we feel that a particular approach is not resulting in a stable method valuation, then we are the right just to quantify that and decide and choose in any other method, basically. Now, if you look into this slide, very interesting slide, that what are the levels of valuation? So for example, if you look into the base, then it's non-marketable minority value. What is non-marketable minority? We just discussed of minority. Now, what is this non-marketable minority? Employee stock options. You have got employee stock options. You have to value employee stock options. Are they marketable? May not be. Are they minority? Yes. So for the lowest grade, which I would say as an example, employee stock options, the valuation is non-marketable minority method. Let's move one step above. Equity shares. Are they marketable? Yes. Are they minority? Yes. You are holding 1%, 2% minority shares, not a controlling stake. Are they marketable? Yes. Equity share. So the base is ESOP. We move one step. It's a common stock or normal equity share. We move one step more. Controlling value or control financial value. An investor has invested 10% in a company. He deserves some premium. He has some special rights. So what is the kind of valuation? The valuation is controlling valuation. Now, control in itself is now segregated into two types. One is a normal financial control and one is a strategic control. Now, what if the other company is my subsidiary? What do we do in that case? What if I own 51%? What if I own 75%? Then I am having strategic control. So in terms of level of value, the strategic control valuation is at the top. Then there is a financial control valuation. Then there is a marketable minority valuation. And the last in the ladder is the non-marketable minority valuation. So just see, as we are proceeding, the complexity is increasing. Do we look all these aspects while we assess a value? Do we ask that what is the percentage of stake to be taken? Understand that if we have to derive, let us say that there is an equity share valuation that we have derived. So that would be a common stock valuation, marketable minority value. But the objective is to arrive at a value for ESOPs. What we need to do? There is a marketability discount that needs to be plugged in. Correct? Now, what if there is a control value and there is from a control value, we have to arrive at an equity value? There has to be a discount, which is kind of a discount for lack of control, which we call as DLOC. Marketability discount is called as DLOM. DLOM. Minority interest discount is DLOM. So when we go up to a control, we have to give a control premium. From a financial control to a strategic control, we have to arrive at a control premium. And just see how the regulations are changing. So now if you are a listed company and a listed company issues certain equity shares and it results in change of control, then the valuer is required to assess quantify the control premium. If we see the latest ICDR regulations of SEBI, then these are the latest changes that we have to arrive at a control premium. Now, how do we arrive at a control premium? Again, we research, we go back, we see that there are companies where open offers have come. How much is the offer premium to the prevailing market price just before the announcement? And you will get an indication of, maybe 20 to 40% control premium that would be there. And that number is broad number. It will change company to company. So it's important to assess. It's important to understand the regulations, and basis that basically we have to proceed. So few questions that comes to my mind is that how are comparable trading multiples and comparable transaction multiples different? We have answered that actually, that the comparable trading multiples result in minority value. Comparable transaction multiples result in controlling value. And here when we are saying controlling, we are not segregating that it's a strategic control or financial control, but that could be another level of discussion. What should be the process for finalizing peer companies? Still unaddressed to a large extent, and I'll try to address this. How should we normalize the financials? We have discussed this. Adjustments of non-operating assets. So when we are doing a valuation and we are doing a comparable valuation, is it required to normalize the financials? Answer is yes. Is it also required to segregate operating assets and non-operating assets? Answer is again yes. Because when we are doing multiples, we are giving a multiple only on the operations. But what about other things? For example, if there is a company which needs to be valued and the company has made investment in another company. Now we are doing the valuation on a standalone basis of the company. So when we do valuation on standalone basis, how do we factor the value of the investments? So we value the investment separately. On similar basis, if there is a capital work in progress appearing on the balance sheet, how do we address that? Capital work in progress means that the company is building something which has not yet resulted in the cash flows. So if we have not considered the impact of those cash flows, we have to value that CWIP as a non-operating item. So we need to segregate the non-operating items. Debt, cash, CWIP, and other investments and other surplus assets needs to be valued separately. So for non-operating assets, there is a 0 period adjustment, wherein first we do the valuation on the basis of operations. And then after that, we do the adjustments of the non-operating asset, which could also include a surplus asset. I'm doing a business. There are 2 immovable properties. On one immovable property, the business is run. On another immovable property, nothing is done. What does that mean? That we need to take the impact of the second immovable property as a 0 period item in the comparable company's valuation method. What about in DCF method? Is it required to do adjustment of CWIP or surplus assets? If the impact of CWIP and surplus asset is already taken in the projections, then there is no need for adjustment. But why these are required in multiples approach? Because in multiples, we are taking the historical multiples. One solution to that is taking a forward multiple also. That we estimate that, but again, would it be an observable input? May not be. Again, depends upon fact to fact. Then what is the kind of discounts and premium like we just discussed? And what do we take? Book values or market values? Like, for example, we say debt equity ratio. So if we have to calculate a debt equity ratio, then what should be the value of equity? If we are benchmarking with peer companies, then should it be the net worth of the company? Or should it be the market capitalization of the company? The answer is market capitalization of the company. We should prefer to replace the market values and avoid using the book values. Even though for unlisted companies, we have to use book values only because market values would not be available. So key issues could be peer selection. How do we find a peer? Current multiple or forward multiple. Outliers. There could be some 80 times multiple and some 5 times multiple, and most other multiples may be in 15 and 20 range. So the lower and the higher exceptional multiples are called as outliers. How do we remove them? Should we remove them manually? Should we remove them of what it is not suiting us? Answer is no. We have to follow a process. How should we take care of the surplus and non-operating assets like we just discussed? And what are the accounting issues and tax aspects? So 4 types of multiples like we discussed. A PE multiple, which is a profitability based multiple, net profitability, accounting profit, and the way because it is accounting profitability, it is prone to accounting adjustments. So I mean, it's not the cash profit, we have to understand, but it is what is reported and clearly visible on the face of the P&L account without any adjustment. That is why it is used in practice. EV/EBITDA multiple, which is actually the most recommended multiple, because EV/EBITDA multiple is an operating multiple. It is not prone to the accounting adjustments to a large extent, because at least the non-cash items are adjusted. And a company suppose is having less debt and a company is having more debt, then also it does not matter because the enterprise value comes in the same range. And after that, you are adjusting for the debt and cash to arrive at an equity valuation. Book value multiples, again, like it's an extension of the asset approach. And in my professional career, my experience is that we use book value multiples for generally banks and NBFCs, because price to book value is how the banks and NBFCs are valued. But in most cases, I would say more than 90% of the cases, barring these banks and NBFCs, we recommend using the EV/EBITDA approach. And EV by sales approach is practically used when the company is not even EBITDA positive. So the only approach that left out is giving a sales multiple, which again, I mean, how prudent it is a matter of debate. but it can be used in practice. So in terms of the information requisition, if we say, then we have to again understand the nature, scope of valuation, valuation date, what is the use of the report, standard and premise of valuation, what would be the assumptions and limiting conditions, applicable laws, regulations, and standards. And we should ask for the financial information, we should ask for a non-financial information, and we should ask for a shareholder information. So broadly, if we ask for these three types of valuation information, I think that could be a starting point for it. We discussed about financial analysis and normalization adjustment also. I have seen most of the time the valuation is started from the Excel. It is the provisional balance sheet or the valuation date is seen and a discounted cash flow is applied. Or a provisional valuation is seen, provisional balance sheet, and basis that a CCM method is applied. I would not recommend and neither advocate that kind of approach. You must go back and look at least the last 2 years audited balance sheet. And you must read the management discussion and analysis report, auditors report, accounting policies, related party transactions, segment reporting. What are the non-recurring and non-operating items? See, all these things required an understanding. And even if my company, the subject company to be valued would be unlisted, there are peer companies. If you are valuing an IT company, you can refer Infosys and TCS. If you are valuing a pharma company, you can refer Aurobindo and Cipla. And there are, different companies. It is very important to normalize and read and understand that how the company is approaching. Like for listed companies, you can also read the management transcripts. Every quarter when the results are come, then there is an earning transcript. Earning transcript is reported. There are investor presentations on quarterly basis that gives an idea of how the industry is approaching, how the developments are taking place. It should not be that we are valuing something on the basis of something which existed like 1 year back, and we are not even aware of the latest aspects. The industry is dynamic, lots of things are impacting. In COVID times, pharma companies were the best performing companies. But in normal stage, these pharma and FMCG are low beta companies. They don't move significantly. So it is important, industry cycles, timing, everything is important. Now coming to the most important question probably for this session is that how do you find the peer companies? See, for peer companies, the most important understanding is knowledge of industry. You should know that where my particular peer company would lie. There is broadly sectors, then industries, and then sub-industries. The valuation needs to be done at sub-industries level. We discussed that. Different industries have different risk and return characteristics and competitive advantages. Basic economic factors of demand and supply provide a fundamental framework for understanding an industry. In India, there is an industry classification which is called as NIC classification, National Industrial Classification 2008. Where do you find it? If there is an unlisted company which has come to us for valuation, how do we find NIC? Go to the annual return. Most of the times we don't ask annual returns. We only ask balance sheet. Ask for the annual return. In annual return, there is disclosure of NIC. NIC is based on the business-wise activity. So if I am doing manufacturing of rice, then all the companies which are manufacturing rice would have a codified number, NIC. If we find the companies, what are the comparable companies which are having same NIC? It will give very useful information and it will result into most of the comparable companies which can then be further assessed. Internationally, like in India, we have NIC. there is GICS, which is Global Industry Classification Standard. And if you look into the BSc industry, that how does BSc categorizes industry? BSc industry is on the pattern of GICS. So the message that I am giving here is that in terms of industries, BSc would have different industries, NSC would have different industries, NIC would have different industries, GICS would have different industries. There are softwares like Capital Line, Capital IQ, Damodaran, all have different industries. What should a valuer do? So in practice, what we do, we use one software, we use NIC, and we use Damodaran database. So we benchmark all the relative valuations using three places. We benchmark through NIC, we benchmark through any software, whether it's a Capital Line or Capital IQ. And there is a freely available data which is given by Professor Aswath Damodaran, which is available for all. We do use that also. So because in India, I mean, Damodaran database is fairly accepted. So once you do these three kinds of segmentation, and let me tell you a problem. If there is a finance company, for example, there is a finance company which is into gold loan. There is another finance company which is a broking company. There is another finance company which is an NBFC company. There is another finance company which is a microfinance company. Sometimes they are not categorized in one industry. They are categorized in different industries. So it's not that we have to solely depend on the software or database. What else can be done? Understanding. So we know that suppose a database doesn't throw Infosys. Suppose a database doesn't throw, known companies. So one more way is we can Google out. We can try to find that what all are the other companies. And there are, free databases as well. Yahoo Finance gives us free screeners. Screener is a website, but I'll tell you what happens. You should be hands-on in using that particular software. Because what happens if you just try to Google and Google gives you certain companies and you use them. And tomorrow, if there are some more companies which come, and by using those companies multiple, the valuation changes. You cannot say that I have just taken a screener. You have to understand that the data should be complete. And when the data is complete, then after that data, what you need to do? So all the companies have come. But then what will you do? There are certain companies which will be frequently traded and there are certain companies which will be infrequently traded. You cannot take an infrequently traded company for valuation because the valuation number could go wrong. So first, our target is that we should segregate the infrequent traded company. The second adjustment is that sometimes all the companies do not have the latest financial information. So if we have taken out the data and there are 2023 data for 10 companies, but 4 companies are having 2021 data, we must ignore those 4 companies. So we can only take the companies which are the latest companies on the valuation date. We should take the trailing 12 months number. Don't take the historical numbers. For example, we were recently valuing a hotel. And see what has happened in companies like hotel is that because of COVID, historically the financial performance, if you look into 2020 financials, it was decent. But then in 21 and 22, the performance was affected. And then again in 23, it has bounced back. So if you go and value a company basis 2022 financials, then the numbers would be very less. And suppose if you derive it with the market price of today, then the multiple would come abnormal. So what you need to do, you need to arrive at a trailing 12 months financials, which is the last 12 months financials. Let's say till, March possible, or maybe December possible, whatever is the data available. And then based on that, you have to arrive at a multiple. So do make sure that the latest financials are considered, and the abnormal numbers are excluded. When we say abnormal numbers, that means that any company which is infrequently traded should not be taken. Third is that we can do some benchmarking assessment. For example, we can benchmark the comparables with the operating profit margins. What are the operating profit margins? And if we find that a few companies are showing very less or very more margins, those should also get excluded. Make sure sometimes when we take EBITDA multiple from a software or even from BSE, then the definition of EBITDA does not exclude the non-operating income. So if you take a multiple, if you take the EBITDA financial from a software, it will give you total EBITDA and not operating EBITDA. But we discussed that the non-operating items needs to be separately adjusted. So what we need to do, we need to reduce other income from the EBITDA. And what is that other income? Actually, that other income is mostly interest income on your fixed deposits, or it could be some other fluctuations like foreign exchange fluctuations and some extraordinary incomes. So if you take EBITDA, then do exclude the other income, then apply a multiple and add the surplus assets, which is the fixed assets, which is the FDRs on which you are getting the income, add that separately. So I've tried to explain that we should follow a process for following the industry approach, and basis that, we have to value the surplus assets and investments separately. Now again, let's discuss on those surplus assets and investments. Investments can again be minority investments, controlling investments. I mean, what should be the methodology of taking that? So again, if that depends upon, what kind of data set we have, basis we can value, and ideally it is preferred that each investment should be valued separately and not taken at a book value. It needs to be assessed again, depending upon what is the data availability, and for that we need to do. How do we adjust for cash and non-operating assets? We discussed, right? So basically, here the point is very simple, that non-operating assets are the assets which are not resulting in your cash flows, which are not resulting in your profitability. So if some asset is already resulting in your profitability, then you don't need to adjust for that. If an asset is not adjusting, if it is surplus asset, then that needs to be separately adjusted. Sometimes when we do peer comparison, we have to look into that my company could be following a different accounting practice than the other companies. I'll give you one example. We were recently valuing a company which was actually, let's say that it has got a contract value of 100 crore rupees, but that contract is to be billed in 2 years. Now, how do you account for that? We know how education companies and how other contract companies do the accounting. And there was a similar discussion which happened in one of the prominent edtech companies. See, there is contract value and there is invoice value. Ideally, invoicing policy would play a major role for this purpose. And when you do your, suppose that there is 100 crores of contract value and that has to be invoiced in 2 years. Now, ideally, my turnover should be only 50 and my turnover will derive my EBITDA. But what if the company books 75% and an auditor approves that? And then a valuer multiplies, gives a multiple of that. So please make sure that what is the accounting policy. multiples approach is very much prone to small changes, because in multiples, we are only taking one number, whether it is sales or profit or EBITDA, and we are multiplying that. So understand that that sales or profit or EBITDA has to be normalized. If we fail in normalizing that particular number which is being extrapolated, the valuation can go totally wrong. It needs to be normalized for the operations. It needs to be normalized for the exceptional items. And that is why, multiple approach could be misleading, and multiple approach, mostly when we do follow other valuation approaches as well. Like we follow a discounted cash flow valuation. We do follow that what are the other transaction multiples which have happened. And, we also look at it from a judgment perspective, because at the end of the day, there are ways to do adjust for the financials. So it's not that if the financials are coming at a particular level, the valuation should also come. There is the role of a valuer who has to adjust for it. What are the contingent liabilities? What are the disclosures? What are the qualifications? A lot of accounting aspects come into play, revenue recognition policies like we discussed. So all these things are actually important things to do. Other than that, there are qualitative assessment as well. I mean, why does Infosys get a better valuation than, a normal company? Because there is a impact of the management as well. So it's not that it's only a financial valuation metrics that result in a particular number. It is also dependent a lot on the kind of the competitive advantage that the company is having, the confidence on the management, the proprietary assets, and probably the sector which is actually in the trend. Because there would always be a sector which would be in trend, and there would always be a sector which would not be in trend. So I think all of these things are important. And one important aspect is that when we arrive at a valuation, so let us say we have taken we have used our softwares and we have arrived at, say, 10 comparable companies. Now we have to do an EV EBITDA multiple, right? Now the median EV EBITDA of those 10 comparable companies after adjustment of outliers, let's say that is coming 20. Now, should we apply that 20 multiple to an unlisted company? The answer is no. Why? Because whether the shares of an unlisted company, whether they are marketable, answer is no. Whether the shares of listed company are marketable, answer is yes. So if we are using a marketable share, right, which is a listed company, and using it to benchmark the non-marketable share, which is at the base, then we have to discount. We discussed that, right? What is that discount? Discount for lack of marketability. So that DLOM has to be applied, and that DLOM can be maybe 15-20% just for a marketability discount. And again, we can quantify that using, option pricing models and all. Again, if we have to use a market price, but we have to arrive at a controlling value, then we have to use a control premium like we discussed. And then there can be other discounts as well. When we are valuing a company and it's let's say
Your video is stuck. Rahul, am I audible?
Yes, you're audible. The video has stuck actually. Let me talk to him.
Okay, Rahul. There is some technical glitch from Rahul from Sir part, so we have to wait for a few seconds.
Let me call him.
Yeah, sure, Rahul.
Hello. Sir.
Yeah, Rahul, I think there is some net problem. I'm just rejoining.
Okay.
Hello.
Yes, sir. Okay. Please rejoining.
Okay, Rahul.
Okay.
To all the participants joining today, I would like to inform you that we have added a feedback form on the right side of the ICI portal, live ICI portal. You can provide your feedback there. Your feedback is essential to us, and I kindly request all the members to take a moment and share your thoughts and suggestions. Your input will help us improve and enhance our future events. Thank you for the participation.
Yeah, so I think there was some problem. Yeah.
Yes, sir.
It is showing host disabled screen sharing. Asta? Yeah. Just a sec. Yeah. You can see my screen?
Yes, sir.
Yeah. So basically, like we discussed, this discounts and premiums, like again, non-operating and operating, we have already discussed. One thing which I wanted to mention again was, regarding the impairment of assets. So let's say we are doing a valuation at a point of time, and the idea was that if there are some abnormal events, like we discussed a COVID event. So we have to understand there that what is the triggering event, whether it is temporary event or a permanent event. And we need to dig deep on what is the positive and negative for the sectors. We have to analyze the business model, the time to recovery, the deeper penetration. So the idea is that if something has happened at a point of time, that does not mean that that thing will prevail overall, right? So it is important to assess and do the normalization relevantly. And one important metric, which again going back to the fundamental, is that what is ability, do some sensitivity and scenario analysis. And that is the way we are expected to do basically these kind of valuations, right? And what more is there? In the couple of slides, I have tried to give some industry valuation multiples. The data is not as on date, it's of January 23. But the idea was to give that this is what is there in Damodaran database. So you go to Damodaran database, you will find the industries, you will find the number of companies, EV/EBITDA multiples, EV by sales multiple, price to book value multiples. So we can actually use these multiples for benchmarking. If we are using BSC database, if we are using Capital Line database, we can benchmark using a Damodaran database as well. It makes sense to not to rely more on one particular company, but what we should try to benchmark it using different databases and different things, so that nothing should get left out. That is the basic idea of these valuation multiples. And one last point to make is that there are also some rule of thumb. So when we do a valuation multiple, suppose there is a data limitation, or suppose something is not available. Let's take, we are an example of an hospital. See, in hospital, what is common in a hospital? The number of beds. What is common in a hotel? The number of rooms. What is common in a mutual fund? The assets under management. So there are some rule of thumb, like for a hotel, basically it's about 1 crore to 1.5 crore per room. I mean, that's a rule of thumb. That rule of thumb has come based on the past transactions which have happened in that particular industry. So exclusive rule of thumb is not recommended, but when we are doing a valuation specifically using a multiple approach, we must benchmark is using a rule of thumb, which is actually a non-financial metrics. We are not looking into a DCF or EBITDA or whatever. We are looking into the structure of the industry, and basis that structure we are doing that valuation. So this is the last slide of the day, in which what I would advocate is that there is a need for uniformity, whether we follow international valuation standards or Indian valuation standards, which are made by the Institute of Chartered Accountants of India, or maybe a standard which a Ministry of Corporate Affairs is looking to make, ethical standards, minimum performance framework. See, let me just give you a broad perspective. I was a committee member in the MCA valuation committee on the valuation standards. And let me tell you that all the valuation standards, whether it's an international valuation standards or, your ICAI valuation standard, these are all guiding valuation standards. So they give a broad guidance of how it needs to be done. But there should also be another standard, which should be a minimum performance framework. Now, minimum performance framework is actually performed in US. And what does it mean is to what extent a professional should do diligence, to what extent a professional should actually, what should you find, how much you should find, where all you should find. I think those questions are more relevant than the broad valuation standards, because broad valuation standards will give you theoretical aspect, but they will not actually tell you that how much detailing, how much is missing in the valuation standards, which actually comes in the minimum performance framework. And I think if we use our professional skepticism, if we upgrade our knowledge, if we do independent research, and if we think logically, I think every valuation can be a good valuation if it can be made logically. So I think with this, I end my presentation, and Asta, happy to answer any questions here.
Yeah, thank you, sir. On behalf of all the participants, I would like to extend my heartfelt thanks to you for sharing your expertise. And I sincerely appreciate your time, dedication, and commitment to imparting knowledge. Now, this is the time to ask the questions. So, 1 second.
Yeah.
So, first question is, in case of unlisted company, if there is some dispute between two shareholders, what is the appropriate validation method for their separation?
See, what happens in case of an unlisted company, basically, if there is a dispute, then first of all, you have to understand that first of all, we should finalize the data for the valuation. I have done a lot of litigation valuation, and I'll tell you what happens, that if you and me, we are two shareholders, you will present a different data and I will present a different data. And then, you can obtain an independent valuation, I can obtain an independent valuation using a different database, and then nothing will happen. So the first recommendation is that we should finalize a common set of data. It should not happen that you say that your projection estimation is 5% growth and mine is 15%. You cannot hold the valuer responsible for that. So the first thing is that we should try to form a standard data set, and then give the same data set to both the valuers to do the valuation. See, valuation approaches don't change. Mostly in that case, a comparable company's valuation, comparable transaction valuation, and a DCF valuation, which is performed based on observable input, would be used. But the biggest challenge that I would recommend to solve is streamline the data. Nobody should be able to question the data, because what happens, I'll tell you, that if the valuation doesn't suit you, then you can very well say that, no, this data was not right. And then ultimately the settlement doesn't take place, right? So finalize the data first, which should be signed by both the parties, and then apply, all the three methods: asset method, market method, and income-based method, and then give appropriate weights to all of these three methods.
Okay. So our next question is, for takeover of working capital intensive company, what will be the correct valuation approach?
For takeover of,
Working capital intensive company.
so I mean, what do you mean by working capital intensive? Like, for example, let's take an example of a company which is working with government projects. So, I mean, government projects, there is generally high level of working capital. So, I mean, it is one characteristic of one particular business. So, what you should do, see, a lot of places you should see that if you find that you are valuing a company and something is not coming out properly. For example, the working capital could be too heavy, the debt equity could be different. We can very well approach a market participant concept. Like we discussed this in days 113 advocates market participant concept. We can again go to the peer companies and we can see what is the median or average of peer companies. So what is the kind of working capital in peer companies that could be taken and that could be considered if we feel that, because it happens sometimes the projections or the numbers which come to us, those numbers are not prudent numbers. So the recommendation in that case is to find comparable companies and take their median and average.
Okay. Our next question is, what will be the appropriate methodology to value NBFC?
I mentioned that price to book value. So for NBFC, DCF method fails. I'll tell you why. See, DCF method, actually, when you follow a discounted free cash flow to firm method, it fails, because here for a normal company, when we do borrowing, then borrowing is considered as debt. But for an NBFC, whatever you borrow, that actually without borrowing, you cannot lend for an NBFC. So for an NBFC or company, the borrowing is a kind of working capital. It is not a debt. So either you follow a discounted free cash flow to equity method, or you follow a price to book value method. Price to book value is largely accepted for valuation of banks and NBFCs.
Next question is it normal practice to use more than one method and evaluate the outcomes? Premises can be very variable as no two business are alike.
Yeah. So first thing, refer the regulations. If there is a methodology in the regulations, you have to stick to your regulations, right? Second, if there is no regulation, then in that case, it is advisable to use, or if your valuation is on going concern basis, then it is advisable to use income and market approaches. Because what happens that why we need to use more than one method? Because if we use just one method, and for example, we fail to exclude some abnormality either in a valuation multiple or in valuation financial, and if at the same time we apply DCF, then if the valuation numbers are too different, you will be able to sanitize. See, valuation is all about, it's a craft. You need to go in detail. You need to understand why differences are coming. So different methodologies result in different numbers, and it gives us a reason, an opportunity to introspect and actually, correlate the valuation methods. However, if you are doing a regulation, one method is fine. Generally, we do not use asset method for a going concern basis, other than if it is a asset heavy industry, but it is recommended to use at least two methods, not one.
So next question is, for instance, my company has most of the assets in leasing model, whereas the industry mostly has its own asset. What kind of adjustment should be done?
No, so what is the business actually? So if you are saying that your assets are under leasing model, and basically you have to understand that you have to compare your industry only with the comparable. If your company is having a different business model, and if you are saying my company is so unique, like for example, when these startup companies came, I mean, now we have these Paytms and Zomatos and Nykaa listed. But if you go back 5 years, these companies were not listed in India. So at that point of time, we used to benchmark these companies with, US listed companies, NASDAQ listed companies. So I am saying that when you do a discounted cash flow, then it is a fundamental valuation. It is not required that, say, if you don't have a comparable, how can you compare? If you are doing a trading company, what will you compare actually? So, I mean, it's not that you have to apply a method every time. It's not required. It needs to be assessed. The facts of the matter needs to be assessed. And if you find that there are adequate comparables, then only you need to apply this CCM method. Otherwise, there is no need of doing this.
For valuation of trademark, how many years discounted cash flow is to be considered?
So see, valuation of trademark actually is an intangible valuation. There is a specific methodology which is called as royalty relief methodology, which needs to be used for valuation of trademark. It is not a discounted cash flow. It is an extension of discounted cash flow. There is no guidance of how many years you have to do. You can take normal 5 years, and after 5 years, you have to extrapolate it with a terminal period, because the life of a trademark is actually perpetual. It's not like 5 years or 10 years. I mean, because ultimately that trademark can get renewed after that period, right? So we will presume that it will go on for perpetual, and that is how it needs to be valued.
So there is one more question, that is to Lars. How far is the startup valuation have been justified? Particularly companies which have come for an IPO and listed. All the companies like Paytm, Zomato, Nykaa, Policy Bazaar have fared very badly post listing. They are also unable to raise further funds. The early investors have actually used the IPO exit to monetize their investments by overvaluing these companies. The above companies have proved that the typical valuation methods have been ineffective and have turned like a Ponzi scheme. Should the valuation method be totally changed for the customary methods?
See, I answered this question. For IPO valuation, there is no formal valuation requirement. If we are issuing the shares, transferring the shares, doing an M&A, there is a regulation. So is there, the first question to understand, is there a formal valuation requirement for IPO? Answer is no. The view of the regulator, and this has been asked time and again to SEBI, that should there be a valuation, but SEBI is of the firm view that let the price be determined with demand and supply. So next time you invest in an IPO, please remember that there is no formal valuation. The merchant banker and the company have decided a value. If it sells, it sells. If it doesn't, then the merchant banker has to underwrite. So first of all, in IPO, there is no formal valuation. Second, the second limb of this question, that wherever there is an investor funded company, the valuation will actually be high, because investor is funding a lot of losses in these startups. So the best way, if you are a conservative investor, avoid these companies. Go stick to the traditional companies, cash flow companies. But if you have taken a shot in, earning in these startup companies, you should be aware. And that is why what SEBI is saying, that please disclose on the face of the balance sheet, the face of the prospectus. When in newspaper you see an advertisement of this IPO, there is written there that the company is in losses. If you read the Paytm or any other company which is in losses, they explicitly mentioned that we are in losses and we do not know when we will turn in profits. Still we invested, no? So understand that the basic concept is demand and supply. When they were funded by investors, investors were there for a long period of time. So they were getting funded and funded and funded. The moment they came to public market, you and me as a retail investor, we expect our return on a daily basis. That doesn't happen. Maybe if you hold them for 7 years, 10 years, maybe the tide will change, the business will grow, the multiples will grow. I mean, people say that maybe Sensex can reach 1 lakh in 5 years. I'm quite sure that, these companies can also double, triple. So, but what is your time horizon? You cannot equate or try to value an unlisted startup company, loss-making company on a daily basis. Now, how were they able to sell it in the market? Because there was somebody else who wanted to buy. So it's always demand and supply, right? So as a retail investor, we can think differently. And as a sophisticated investor, they think differently. So best to avoid if there is uncertainty and losses actually.
Okay, last question is, can two valuations be given in case assets or liabilities involved subject to some contingent event like court judgment or arbitration proceedings?
No, please come again.
Can two valuation be given involved subject to some contingent events like court judgment or arbitration?
No, why do you want to give two valuations? See, what happens that if there are some legal cases, right? Then one thing is that if you are not taking cognizance of those legal cases, you should give a disclosure that this valuation is without considering these contingent liabilities, right? Because let me tell you, how do you value contingent liabilities? It's a difficult case. You need to go into a lot of legal document, understand, and this is a problem which happens in IBC cases. That, I have given loan to a company and that company does not have money. How do you arrive recoverability? So you have to see that what is the kind of the case, who has won at a legal forum, what is the probability, whether there is a legal opinion. But there is nothing like two valuations. You have to give one valuation wherein if it's a non-IBC valuation, you can take a call of not adjusting for the contingent liability. But if you have to take a contingent liability, maybe you can seek for an opinion. Unfortunately, in IBC cases, you cannot do. You have to apply your mind and you have to do greater diligence to actually assess that what an outcome could be, which could be actually challenging in itself.
There is one more question, sir. The question is, you mentioned we should exclude other income from EBITDA valuation, but other income majorly is from interest income earned on FDs, which I logically feel is operating in nature, not the main source of income, but operating income. So why should we exclude it?
When we apply EV EBITDA multiple, see, if you look into how do you calculate from enterprise value to equity value. So you do two adjustments. You reduce the debt and you add back the cash, correct? So cash and cash equivalent, which includes your FDR also. So you add not only the cash, you also add the FDRs. So if you look into the FDRs, then FDRs actually are not the business. FD, how can FD could be the business of the company? Business of the company is basically, doing some manufacturing or sale. FDR is not the business of the company. It is the extra fund which has got created. Unless and until, if it's an NBFC company, you can take that stand. But for a normal business, I don't think that FDR is a main business of the company. And other income not only will include FDR, it can also include all the other exceptional and non-recurring items. So that is why as a standard, I have said that you exclude everything and you add only the FDRs so that non-excluded gets excluded and cash and FDRs are included when you are calculating the equity value, basically. That is how it is done in practice.
Yeah, okay, sir. Thanks. On behalf of the Valuation Standard Board, I would like to extend my sincere gratitude to you, sir, and to everyone involved in making this webinar a valuable learning platform. I hope that the knowledge gained today will empower all the members joining today in their professional endeavors and contribute to their continued growth and success. I would like to again inform everyone that please fill the feedback form that is mentioned on the right side of the live ICI portal and provide your valuable feedback today. Thank you once again, sir, and everyone. We look forward to welcoming you in the further future events. Have a wonderful day ahead.
Thank you so much, Asta. Thank you to the Valuation Standard Board of the Institute.
Thank you, sir. Thank you. Thank you, Asta.
Bye.
Thank you, Rahul.
Thanks, all. Yeah. Bye.
Okay, bye.